Welcome to this week's Credent Connect series. And today we're going to focus a little bit on our positioning and outlook here for the second half, both from an economic standpoint and an investment standpoint, right? Putting the thoughts and views into actionable steps. And if you recall, maybe 2-3 weeks ago when we did our last Credent Connect series on investments and the economy, the theme was, what is that next headwind or tailwind? What's the next focal point from a financial media standpoint in terms of things that can drive returns, volatility, sentiment, you name it. We left the heels of the debt ceiling discussions from back in June to now in the second half of the year where earnings are back at the forefront, where the potential for that recession worry has resurfaced once more again. And the reality is things haven't changed much from a structural standpoint. And what I mean by that is, as we look at the economy on a broader basis, as we gauge consumer sentiment, the labor market, ability for discretionary income to stay steady or increase, all the components that are actually driving consumption and what's likely to be a neutral earnings backdrop for the second half, not much of that has changed. What's happened, interestingly enough, is that a lot of the gains we thought would get in the second half of the year, maybe those were pushed forward a little bit to a point where things may be a little more neutral in the second half, yet neutral from an index standpoint, not from a strategy standpoint. So, Alisha, talk to us a little bit about how we take that macro backdrop. And the indices are certainly biased in the fact that they're over-concentrated to a certain number of names. What are we doing? What do we do here in the second half to position ourselves both for a potential for volatility, yet also trying to capture and benefit from that along the way?
Sure. So over the long run, we are more constructive on equities over fixed income, but we are finding good opportunities within fixed income that we haven't found in many years.
Yeah, decades.
Exactly.
Yeah.
So when we look at the fixed income space, what we're seeing is that we can stay high quality and still get some really good yields. And so that's what we're doing. We're staying high quality. We're also coupling those with things like principal protected notes, which allows us to generate returns on the upside and participate in the equity market to an extent, but have full protection on the downside.
Yeah.
So within fixed income, we're also seeing opportunities to increase duration because we feel that the Fed is close to the end of their tightening cycle.
Yep.
And so as rates do fall over the next couple of years, that we will be able to take advantage of that dynamic.
Yeah. On that interest rate front, it's quite interesting. The Fed is likely to probably maybe raise rates in July at this point, probably more than a 50% chance of that happening. But it is looking a little more neutral post that fact to potentially even hikes starting in the early part of potential decreases in interest rates starting in the first half of next year.
Mm-hmm.
On the equity front, right? Equities tend to be a little more exciting than bonds.
Yeah.
On the equity front, talk to us a little bit about our positioning and the reasons why we're favoring large cap growth in this case a little bit. Then what are we doing in the mid and small cap space?
Sure. So on the large cap growth space, what we're seeing is that we have a lot better earnings expectations on the growth side than what we're seeing on the value side. Growth is a little bit more expensive than value, but when we're looking at how our earnings is going to play, what is the forward guidance, what do technicals look like, we're seeing a lot more opportunity in the growth space than the value space, especially if we do head into some sort of slower growth space. Growth tends to outperform in that environment.
Yeah.
On the mid-cap space, we do feel that we have a good opportunity within our mid-cap selection process. So what we're looking at are things like revenues, cash flows, what does volatility look like,
Yeah.
what are valuations looking like? And so instead of going in at the index level and generating all of the systematic risk, we're looking to take unsystematic risk, meaning that we want to select those individual securities that we think will perform well in this environment.
Yeah, very, very well said, right? One of the things that we do very well on that front is when we try to capture a certain level of risk or volatility, we have a better grasp on that when we forego things like mutual funds or things like really concentrated ETFs and going directly to the source and deconstructing the backdrop. That tends to provide not only risk benefits, but also tax loss harvesting benefits down the road. Thank you for that. As we look at, say, potential adjustments here into the third and fourth quarter, a question we often get is, what is the next catalyst we're looking for? Or rather, what are the 2 or 3 catalysts we're paying attention to gauge whether we want to pump the brakes or not, right? Or how hard we want to pump those brakes. And one of the interesting things that's uncoupling right now is looking at the PMIs, right? The Purchasing Manager Index, manufacturing indices, and services indices, not just in the US, but globally, and also out of China, right? There tends to be this forward-looking notion that if those do drop, there tends to be a small lag in other global economies from an import-export standpoint. We're paying very close attention to that as the earnings season here uncouples, gauging comments from companies in how their expectations are going to pan out over the next 3 months, because the reality is equities tend to price themselves on forward guidance significantly more than current earnings backdrop. So we're paying attention to that. We're ready to act. Various tools in place, already have some cash built on the sidelines to be able to act with opportunities. And we look forward to being very objective in that process and acting in our clients' best interests. Thank you.